It does take us to our talk of the tape, the road ahead for the rally. Let's welcome in Wharton professor Jeremy Siegel. He joins us now. Professor, welcome. It's nice to see you again.
Happy to be here, Scott.
So how's this market look to you now, Professor? We got through NVIDIA, knocked the cover off the ball again, and we had a turbulent day yesterday, and a nice bounce today, at least in parts of the market.
Yeah. Well, I think NVIDIA did so well, it almost sucked all the oxygen out of the room, so no one else could breathe yesterday. And now I think they settled down. And I think what disturbed people yesterday was that little chatter in the FOMC minutes about some people saying, hey, are we done raising? I mean, that would drive a stake into the heart of the bull market. So any talk about that brings about fear. Now, I absolutely do not think that that's going to happen. I think a little settling down right now. I actually think the forward-looking data that we're going to be getting, and really even are getting, is going to look much better on the inflation front. So it is a question of how many cuts and not a question of whether there'll be another rise.
When's the first cut coming, if at all, this year? I mean, that remains the most sensitive debate within the market. You know, if the economic data comes in too good, then the market thinks we're getting no cuts. If it starts to look a little dicey, then the market says, okay, well, maybe they will cut. But what do you think?
Well, you have to understand, people say we will welcome cuts, but there's a good reason for cuts and a bad reason for cuts. I mean, the good reason for cuts is we see a slowdown in inflation, and that would cause this bull market to keep on going and going strong. The bad reason for cuts is that we see a big slowdown in the economy, and despite cuts, you're going to have a declining stock market in that case. Now, fortunately, we had weak data last week. This week, the data looks a little bit better to me. I'm calmer about it, and I think that this GDP. Most of the, I think Atlanta, Goldman Sachs, all the others are calling for the low threes for this quarter, and that is certainly good enough to keep this bull market and the economy rolling.
Wow, so I think that's why, some make the argument that cuts don't matter, earnings matter, and earnings are good enough to continue to carry the market higher. I had an interview with Rick Reeder of BlackRock, right? Watches a lot of flows, and he is in charge of a lot of assets. And he says, Professor, you could get 10 to 15% more this year out of this market.
Absolutely. I mean, one thing, we're going to get the second revision of first quarter GDP next week, and it's going to go down into the low ones. Now, think about it. Low ones, and we had such good earnings with 3 GDP this quarter. Earnings are going to be so much better.
You think earnings are going to just continue to be better, right? Because, I mean, NVIDIA is sort of a perfect example, Professor, where, the critics would say, yes, the earnings were good and they were better than, continuously lower expectations. But all of the really good earnings are coming at the really top of the stack, right? The mega cap stocks.
There is no good.
Professor, I got you. I'll take care of you. Why don't you grab some water? I've got some other guests here that I can ask some questions to as well.